Good afternoon, everyone. Thank you for attending our webinar series today. My name is Tyson Mavar, one of the ExxonMobil focused retirement advisors for the retirement group here in Texas. And on today's webinar series, we're going to be covering the ExxonMobil pension plan and some of the very important issues relating to the interest rates that affect the lump sum payout, as well as some of the other benefit payout options that employees have on taking their pension after they leave the company. Those of you who aren't as familiar with our company, Retirement Group is an independent financial planning organization. We specialize in helping corporate employees plan for and transition into retirement. We are not associated with ExxonMobil in any way. We're not affiliated with the company nor endorsed by the company, but we happen to have many clients from ExxonMobil who have retired and entrusted us with helping them preserve and grow their wealth into retirement. And leading up to retirement, we like to spend time with the folks that we would hope become our clients in the future, going over some of the important decisions that they have to make leading up to retirement. Many of those having to do with the pension plan, which we're going to focus on in today's call. We have a whole host of complimentary services we encourage you to take advantage of as you approach your transition from ExxonMobil. Cash flow analysis, we do completely complimentary for employees looking to get an idea of where they stand with regards to their retirement and what they should be doing to prepare for their transition and maximize what they walk away from the company with. And a whole host of other analyses that we prepare for employees leading up to retirement. Webinar library that you can peruse at your leisure to learn more about some of the topics that are of most interest to you and your family. And Retirement Planning Center for ExxonMobil employees, where we have podcasts, we have articles you can read, ebooks that are pretty quick reads in many cases. I encourage you to take advantage of all of these, and then also if you're not following us on LinkedIn already, highly encourage you to do so, because that's where we publish a lot of our live and recorded video webinars going over the ExxonMobil retirement planning strategies. Most of our clients that leave ExxonMobil, we build a cash flow analysis that typically consists of at least a pension plan, at least a 401k plan, maybe some other assets that they had saved, previous company plans, spouse's assets potentially. But for most people, they also have the Social Security benefit that our goal is to help them pick an income strategy with Social Security that's going to give them the highest probability of getting the most money from Social Security and the least taxes possible. These are the foundation of the retirement plan that we put together, the cash flow analysis that we build for folks. And today we're going to focus on the pension plan options and some of the important timing rules when not only retiring from the company but also deciding to take that pension. Many of you know that there's many different benefit distribution options on the pension. The lump sum has been very attractive and popular for many years in the low interest rate environment that we've been in for the last more than a decade. Although interest rates, as many of you know, have increased pretty substantially in a very short period of time, which has made the lump sum option less and less attractive as the payouts have gone down in this rising interest rate environment. So we also have a variety of annuity options that make a lot of sense for people depending on their circumstances. We have a single life annuity, which is the highest pension possible on a monthly basis at least. Then there's a variety of different joint survivor options where you and one other person, typically a spouse but not always, will have assurance of guaranteed lifetime income from the company. And then also this period certain option, which is like the single life annuity in that you will have income, you the retiree or the employee will have income for the rest of your life, plus an additional benefit that if you pass away in a certain period of time, and you can pick whether it's 10, 15, or 20 a year, what they call extended period certain, that there will be an additional death benefit payable to your beneficiaries, assuming that you don't live until that extended period that you chose when you left the company. But you'll still have guaranteed income. It just is a lower lifetime payout because of the additional death benefit, if you will, that's attached to that lifetime payout. They also, a few years back in 2015, created a hybrid option wherein employees can now take a partial lump sum and partial annuity. And the flexibility with that is you could take 25% of your pension as a lump sum, 50%, 75%, and of course 100%, with the remainder being paid out as one of these various annuity options. So lots of flexibility. Unfortunately, if you leave the company prior to being what they consider a retiree, which is at least 55 years old with at least 15 years of service, your options to take a lump sum are not as flexible. You actually have to elect a lump sum pretty quickly after you leave the company, and you don't get to pick your benefit commencement date like you do when you're a retiree. I believe it's forced 3 months out from your retirement date, meaning that if interest rates are going up, you might suffer losses on your lump sum that are outside of your control. So typically we encourage people to at least make it to the 55 and 15 benchmark, not always, but usually, because of the additional benefits that are gained once that milestone is reached. But there is some additional flexibilities that are awarded to people that do make those age and service criterias. Now the formula, how the company calculates your annuity and then of course converts it into a lump sum, they're going to take the final average pay, which is the highest consecutive 3 years in the previous 10 years that you worked at the company. They're going to take an average of those 3 years to come up with a 1 year average final pay. They're going to multiply that by 1.6% and then multiply that by your total years of service with the company, including a prorated service. Of course, months and days will count in this calculation. Then they're going to subtract off what they call a Social Security offset, which is a function of your projected age 62 Social Security benefit. And interestingly enough, the company does not always calculate your Social Security benefit correctly. And in some cases, this is to your detriment as an employee, because they will be underestimating what your pension payout is. Fortunately, you can, if you do the math correctly and identify this problem, you can prove to the company that it's a problem, and they will update your benefit calculation, and in many cases creating a larger both lump sum payout and annuity payout for retirees. However, sometimes they also get this calculation wrong and it's in your favor. And for our clients, we normally recommend not telling the company about this in an effort to maintain a higher payout, because they will also adjust the benefit downward, not in your favor, if your proof in sending in your Social Security statement suggests that that's what they should do. So work with the retirement group or a benefit specialist, somebody that understands the ExxonMobil plans, to identify if this is smart for you to do when you leave the company. One example, I have a client in West Texas who increased his benefit by close to $33,000 on his lump sum because he turned in his statement and found out that the company got his calculation incorrect because of his Social Security benefits. Now, typically, most people want to work until age 60 at the company because that's when there are no longer age penalties on the pension. But it turns out you can still retire prior to age 60 and wait to take your pension, and you can continue to age out of penalties. For instance, I have a client this year who will be retiring near his 55th birthday, and he's going to probably wait to take his lump sum. He's planning to take the full lump sum still, even with the higher interest rates we've seen. Probably going to wait to take his lump sum because every month he waits past his retirement date, his lump sum will be growing because he will be aging out of penalties up until he turns age 60, so potentially for 5 years. However, you have to remember too, though, that your lump sum will go up and down depending on what interest rates are doing after you retire if you wait to take your pension. So one of the risks of deferring the election of your lump sum is that interest rates could go up after you retire, thereby creating a lower lump sum payout. So there's two big moving parts that we want to look at. And for this individual, my recommendation was to be not certain about when his benefit commencement day should be yet, and we will monitor what interest rates are doing. And if interest rates happen to increase a large amount from one quarter to the next after his retirement date, we may recommend just taking the lump sum to avoid further losses that are associated with the interest rates. Even though he might be taking his pension with some age penalties, it could be to his long-term benefit in doing so. Those penalties, by the way, are 5% per year for every year under age 60 that you decide to take your pension. So potentially 25% penalty. Although one of the benefits of higher interest rates now is that fixed income and some of the more conservative investments in a retirement portfolio are now paying a lot more interest. So if you are of the opinion that you can easily achieve 5% on your own, either in your 401k, an individual retirement account, or IRA, then those age penalties might not bother you that much to begin with. And the opportunity cost of not being able to invest that money while it's sitting in the pension plan needs to be considered in this timing decision as well. Now I'm going to zoom in here to look at both the age penalties for retiree. A typical retiree, you can see we talked about the 5% per year, 25% if you leave and take your pension at age 55. But then if you retire on disability, you can actually take your pension prior to age 55, but the penalties are going to be even more severe. For instance, somebody who takes their pension at age 50 is only going to walk away with half of what they would otherwise walk away with if they waited 10 years until age 60. So not an easy decision for everybody. We encourage you to work with us or whoever is helping you with these decisions to identify the merits of leaving your benefits at the company versus taking them and getting them reinvested, as well as maybe creating some income from those benefits after you no longer have a paycheck coming from ExxonMobil. Probably the most important slide today, covering the interest rates as they just were released for the second quarter. Now it's important to remember two things. One is that not everybody's interest rates are observed the same. What I mean by that is some individuals at the company are grandfathered into using the lower and more favorable 30-year treasury bond interest rates to calculate their lump sum. And so we'll talk about this quickly because it's very few employees anymore that are considered grandfathered. But off to the right you'll see the quarter 2 2023 grandfathered rate was 3.75. That's 75 basis points or 0.75% higher than it was in the first quarter. So we know that rates are going up to a big degree for grandfathered employees. And what that means in plain English, every 1% increase to the rates is roughly a 10% drop in lump sums. So for a typical, probably a 60-year-old here, they might be losing 7.5% on their pension. $1 million pension, that's quite a bit of money. That's $75,000 overnight that they're losing on their pension on average. It also is a function of your age and how much these interest rates affect your lump sum. That's a lot of money to be losing overnight. So this could be a consideration for a grandfathered individual to not only leave the company before the second quarter, but also take their pension before interest rates are updated. If they were close to retiring anyway. If they were a few years out from retirement, it might just make more sense to continue working because of the enjoyment of the paychecks along the way. Now that's probably less than 3% of the entire community of ExxonMobil employees that are grandfathered. The vast majority of our clients and people that we talk to today are using the corporate bond segment rates, which are the three columns to the left or in the middle of this table here. First, second, and third segment rate you'll see. So again, these are based on corporate bond interest rates that are higher than government bond rates. There's 3 of them rather than 1. And to make matters even more complicated, there's 2 months that they take an average of and blend them together to get what they call, or what we're calling on this table, the quarter 2 2023 blended rates. And you can see that in the third row here. Those rates are what you will be using to calculate your lump sum if you take your pension in the second quarter. So here we are in the first quarter. Our clients have a window of time where they can now make an educated decision on whether to leave now, take their lump sum, probably avoid some losses, or work another 3 months into the second quarter, possibly with a smaller lump sum, but with the additional 3 months of paychecks. This is not an obvious decision for everybody. It's not a one-size-fits-all, in other words, recommendation. Because your age is also a factor in how sensitive your lump sum is to these interest rates. The younger you are, the more your lump sum will drop for every 1% increase in interest rates. And likewise, the older you are, the less of an impact your lump sum is going to have when interest rates go up. For example, typically a 55-year-old experiences roughly a 12% drop in their lump sum for every 1% increase to rates, versus a 65-year-old, it might only be closer to an 8% drop in their lump sum for every 1% increase to rates. Something else that's really important to remember is that these second segment rates have much more bearing on the lump sum calculation. For instance, the second segment rate actually is 3 times more relevant than the first segment rate based on what years of future cash flows that they discount back to a present value, making it the interest rate that we're most interested in focusing on, this second segment rate, where you can see it's 5.38 for the second quarter. That compares to 4.94 for the first quarter, which is a 44 basis point increase. That might mean close to a 4 to 4.5% drop in a lump sum. Now, when you compare that with your additional benefits of working at the company, could be not only your salary is probably the biggest one, but your company match in the 401k plan. There could be some restricted stock units that you have vesting. There's a less expensive health care while you're working compared to when you retire. A lot of moving parts that we want to evaluate in this cost-benefit analysis of when's the best time to leave. But somebody who's younger is going to be affected by this interest rate increase much more than somebody who is, let's say, in their mid to late 60s. So keep these in mind. We also have below the current rates and what's changing where the rates have gone in the last year. And you can see they have increased dramatically on all levels. See, the second segment rate has basically doubled, more than doubled, since the beginning of 2022. And for a lot of people, that has meant 30+% drop in their lump sum. Now, does that mean you shouldn't take a lump sum? Not necessarily, but it might be a lot less attractive now compared to where we were a year ago, although so are investments potentially, whether it's because you're buying stocks with a portion of that money that are now a lot cheaper than they were a year ago, or if you're buying fixed income investments like bonds, or even potentially annuities as a portion of your retirement plan that now have better payouts and better yields, better interest payments. All of these need to be evaluated in this decision. And what more people in my experience this last year have been doing is considering taking a portion of their pension as an annuity in an effort to hedge the risk. Of course, there's a lot of different reasons you would take a lump sum versus an annuity that have to do with your life expectancy, which might be a function of your health, as well as your genes, previous history, how long people normally live in your family. It's also going to be a function of your tax bracket status, your cash flow need in retirement, and the importance of flexibility in that cash flow need, whether or not you plan to go back to work after you leave ExxonMobil. Your risk tolerance is a big deal here. Somebody who is ultra conservative might be better suited for an annuity versus somebody who is okay with some volatility in an effort to get better growth and fight inflation, might be more attracted to the lump sum. Family circumstances, there's a lot of variables in this decision, and it's one of the most important decisions that we see people making, and an irrevocable decision. So definitely one that you want to spend some time on as you approach your transition from the company. And we're delighted to spend some time with you in running this cash flow analysis and talking about the potential benefits and potential detriments of these different options on how you take your pension, as well as the timing of electing to take your pension. Unfortunately, statistically, 74% of Americans over the age of 50 do not have a written plan for their retirement. This is absolutely unacceptable, folks, especially because a variety of advisory groups, including ours at the Retirement Group, are willing to put a plan together for you on a complimentary basis in an effort to get to know you and for you to get to know them in an effort to hopefully earn your business. Take advantage of this. It's a free service. It might take 15 minutes of your time to gather the inputs that we need, and then usually about 30 to 45 minutes to go over the numbers on a web meeting or in-person meeting. So let us know if you have never done this. We'll let you know what we need to put this together, or if it's been over a year since we've updated your plan and you're still working, especially for our clients that it's been a while since we've updated this. Now's a good time to be updating your plan because a lot has changed in the last year. Not just interest rates, but tax rules that affect retirement accounts and the markets where we are, especially if your time horizon, if you're closer to retirement, it's probably good time to update the plan and see how things have changed and what you might want to change in your 401k or other assets to account for some of the changes that have come our way. If you'd like to schedule a meeting with myself or any of our ExxonMobil focused advisors at the retirement group, you can call us at 800-900-5867. You can email us at info@theretirementgroup.com. You can also take a picture of this QR code on the bottom left here to get onto one of our calendars so we can walk you through this information and start putting a plan together for you. We do have some questions that came up this week, so I'm going to go through 3 of them. The first question, with interest rates so high on the lump sum, does it make sense to just take an annuity from ExxonMobil? Also, is the annuity insured? So this is a 2-part question. The second part, the annuity or the pension plan, if you take it as an annuity, is insured by the Pension Benefit Guaranty Corporation. It's a government institution, or PBGC for short. Although we've seen some companies that have gotten into trouble and whose retirees, their annuity recipients, have received reductions in their pension payout as a result of the future of that business that they retired from. Sears Roebuck was within the last couple years we saw this. A lot of the airline and automobile companies had issues. A lot of companies have also sold off their pension liabilities in the past to insurance companies like AIG, Prudential, some of the other big U.S. insurers, where now they are no longer the owner of the liability. It is passed off to an insurance company. So while ExxonMobil still has a very strong pension plan, and that's not a concern on a lot of the people that I talk to's minds, it's certainly one that needs to at least be considered. But the first part of that question, does it now make sense to take a annuity? Like we talked about, it's a little bit more attractive for some people that have seen their lump sums go down 25 to 35% in the last year. The annuity option has not dropped during this time as a result of rising interest rates. So relative to one another, the annuity might look more attractive, but there's a lot of other factors that need to be looked at when making this decision, like we mentioned today. Question 2, my coworker left last year and she said she locked in her lump sum at a lower rate. Did I miss the window for this lower rate? Unfortunately, you probably did. If you haven't left the company and taken your pension, even if you left the company last year but neglected to elect your pension, you fill out all your paperwork, tell the company what day you want to commence your benefit. If you didn't do that, and you're not sitting on some paperwork that allows you to do that after the fact, because there is a window of time they'll give you to get the paperwork back before it becomes erroneous, unfortunately, you probably missed the window. Question 3, why do some of my coworkers who also have 23 years have a substantially larger lump sum than me? So this could be a variety of issues here. You may have made less money than them during your career, because remember, your final average pay, your salary, is a component of your pension calculation. If they are older than you, they may have aged out of some penalties, even if you have the same years of service. On the other hand, though, there's actually a detriment to getting too old on the lump sum, because after you turn 60 years old, now your life expectancy becomes a factor in the company calculating your lump sum. What I mean by that, like we mentioned earlier, how the interest rates affect people differently based on their age. Well, the lump sum's actually also calculated based on your life expectancy, and the older you are, of course, the shorter your life expectancy is, and the less money the company has to give you as a lump sum, as it turns out. Because effectively, they expect you to live a shorter life and collect fewer annuity payments if you were to take the annuity. As a result of that, they don't have to give you as big of a lump sum either. So this is why a lot of people see, once they work beyond age 60, not only is the lump sum falling because interest rates are going up, but the lump sum is probably also falling potentially because of your age. So a couple issues there, but I'd have to look at your specific situation to tell you. My best guess is probably because you had different salaries than that individual that had a larger pension but the same years of service. So with that, we're going to wrap it up for today's webinar series. Thanks everybody for making some time for us. We appreciate joining us for today's webinar. If you have any questions, again, feel free to call us at the home office at 800-900-5867. And we hope to talk to you all very soon. Thanks again.